Hello, everyone, and welcome to the NASDAQ Dorsey Wright Monday Analyst Discussion for this Monday, December 7th. My name is Ian Saunders, and joining us here as well is Will Gibson. And Will, coming in to a relatively muted movement from most kind of major domestic equity indices, at least at the time of this recording this afternoon. Seeing some indices like the Dow and the S&P, at least again at the time of this recording, posting slight losses on the day, whereas the NASDAQ is posting a slight gain at the time of this recording here. And that's coming in or on the backs, rather, of some kind of continued broad participation of the upside that we've seen from many areas across the domestic equity space over the past couple of weeks here, with a few months ago seeing that kind of big pickup in laggard participation from some of the more out of favor areas, such as maybe small caps and some of those laggard sectors, but showing a little bit of a resurgence, at least recently, over the past week or so, from some of those high relative strength areas there. Well,
yeah, Ian, definitely. And I think the performance table here really visualizes that. We have it sorted by 7-day performance. So our best performing group actually is that energy sector, as Ian was mentioning, a previous and heavy laggard on the year, showing strong the past week as well as the past 30 days, notching a return now just shy of 40% for that broad sector. So a lot of strength there. One thing interesting to note, though, as we were talking before, is that an often related commodity is going to be that crude oil group. And we note that down maybe towards the second half of the ranking, still positive over the past 7 days, but not as strongly positive as that energy group. So that'll be an interesting relationship to monitor going forward. Some of the other notable performers across the top, we want to make note of healthcare and technology, by and large, leaders on the year. So interesting, you're seeing your laggards outperform and perform well, while some of the leaders are also still doing the same. Technology, of course, and healthcare being one of them. So that's a point to note as well. But as Ian mentioned, just broadly, there's a lot of participation. There's a lot of things that are working right now. You'll note a lot of momentum strategies towards the top, indicating that you're still having those leaders participate, as those are latched on to those leaders still. Also note just the S&P equal weighted index is one of the best performing, speaking to that broadening participation. And then we also note some international representatives continuing higher, meaning the participation is not only on the domestic front, but on the international side, as we'll touch on with a lot more color later. You have your emerging markets group pushing higher, along with some various other countries and areas within international, like I said, that we're going to try to close with today. But Ian, by and large, a lot of participation, a lot of things that are working well, whether it's on a 7-day basis or even on a 30-day basis. We're seeing a lot of green on the screen right now. So by and large, things are ticking higher. No material movements from leadership trends, but albeit still positive from this view, at least so far.
yeah, absolutely. Well, and I think that point that you touched on there with, energy continuing to show that strong returns, but some other areas showing that improvement as well. That energy trade, I think, or that movement is especially interesting to note. Like you said, we're seeing a little bit of more dispersion there over the past few previous weeks. Crude oil and energy have both been some of the higher performing areas over a trailing 7-day time perspective. And we still see that from the energy space. The crude oil has backed off a little bit. And interesting to note for those of you that follow some of the models that we have on the platform, we've had some energy-focused equity funds come into a few of our sector rotation models, kind of in a similar fashion to how we saw those trades work out several months ago there in the summer. So it'll definitely be interesting to note to see if that improvement from the energy space can be sustained as we head towards the end of the year here. But yeah, just like you said, having the most sectors kind of continuing higher has led some of the broader market itself up to new all-time highs there.
Yeah, Ian, that's right. And as we're showing now, the S&P 500, that cap-weighted index, showing the 20-point chart. We were really close to hitting 3,700 last week, so continued follow through to the upside in that current column of X's as we see. We do have initial support on the chart at 35.60 and 35.20, as we have highlighted. This can be seen as a positive sign that we do have some stair-stepped levels that we can look to should a pullback or should any type of event happen. We do have some levels that we can use to or look to see if we can hold from. Something else that we also want to talk about, and it has been discussed that, the market's a bit extended right now, whether what metric you look at it or if you would agree or disagree with that. One reading or way that we'll track extension is through that weekly overbought reading, currently at 65% for the S&P 500, but albeit note that that's not a level that we would consider significantly overbought, as we can touch on in a little bit, but by and large, that's indicating a lot of just upward participation, but not a ton of froth from that current reading. Something else I do want to mention, just talking about participation, if you're familiar with some of our bullish percent indicators for maybe BP SPX for the S&P 500, BP NDX, talking about the NASDAQ, that's actually up. That continued higher into X's. We're at 74%, meaning 74% of stocks in the NASDAQ are trading on buy signals. Similarly, if we look at like the New York Stock Exchange, a bit wider universe there, we're at also 74% on that reading. And if we're looking for follow through, we also have a multiple buy signal, bullish percent, which tells us the percentage of stocks that are trading on consecutive buy signals. And that's currently matching its highest level since, well, June of this year. And then before June, you have to go back to 2013 to see those levels. So a lot of participation, but from the reading right here, still a positive picture, Ian.
Yeah, absolutely. And like you said, I mean, that multiple buy signal is one indicator that we're really kind of tracking pretty consistently there as the rally was really getting underway in late spring, early summer. Looking for that consistency of strength in the market, right? I mean, that's the whole idea behind that indicator, is having names trading on at least 2 consecutive buy signals, showing that consistent follow through to the upside. And consistency is another thing that we've seen from an improvement standpoint in risk on areas within some of our relative strength breakdowns as well, such as the DALI tool, the dynamic asset level investing tool. Looking at it from the broad asset class ranking, again, this tool is coming in and sorting the 6 broad asset classes by relative strength, looking to identify which areas have shown the most kind of consistent outperformance among the rest of the global markets. And domestic equities has continued to pick up buy signals. We saw, at least as of the buy signal count through market close on Friday, domestic equities gaining another buy signal. We've been up to 325 buy signals. So continuing to further itself from really the rest of the asset classes on this ranking. But international equities as well, that, as Will said, the improvement in equities is not just limited to the domestic side. We've seen the continued improvement from international equities after it moved into the second position there a few weeks ago, continued to significantly show significant gains from a buy signal perspective, picking up 13 signals last Friday alone, moving it to a current buy signal count of 221. So while we continue to see that significant improvement from international equities, still sits about 100 signals behind the domestic equities space there with 325 compared to 221, but distancing itself further from that fixed income asset class, which remains in the 3rd ranked position. Some other interesting changes to note in the bottom end of the DALI asset class breakdown is the recent improvement in commodities. Some of this strength that we've seen that we commented on earlier. From the commodity space with areas such as oil continuing higher has led the broader commodities asset class to continue to pick up a few signals, while cash lost some signals last week to move commodities into the 4th ranked spot at 134 signals and cash at 130. We do typically note that we do look for a 5 signal differential between the asset classes to really cement a change, but that's more so going to be focused on improvements or changes in the top end of the rankings that might affect some of the tilt allocations that you might use in your respective across your respective businesses. But definitely an interesting change to note with commodities overtaking cash in the rankings there, and we'll look for that to see if the kind of continued improvement in that commodity space can lead it back in the top half of those rankings. And looking down at some other more focused comparisons, right? So we have the broad asset class comparison, relative strength comparison that we see up top. And in another way to kind of view how strong each asset class is through a couple different comparisons we have for the asset class against cash specifically. So instead of comparing each asset class against every other asset class, we can use indicators such as a cash percentile rank and the bogey check to compare the asset class against just cash. The bogey check against cash is going to be looking at one of the more near-term focused indicators that we have available here on the system. It's simply comparing a single representative from each asset class against a cash proxy to look to see if that relative strength chart is in a convex as it passes. And as we can see from the breakdown on the page, every asset class is currently passing its relative strength comparison against cash. Looking at it from a little bit more intermediate term view would be the cash percentile rank, taking a basket of representatives from each asset class and then ranking those from a relative strength perspective and putting cash in that ranking as well, with the cash percentile rank simply telling us what percentage of names in that basket of representatives in the asset class is cash beating. And we saw that reading drop down to 0% for domestic equities. So domestic equities is every representative we have in that matrix is beating cash in that relative strength breakdown, which speaks to that breadth of improvement that we've seen from the domestic equity side of the picture. But we've also seen a similar breadth come into play over the past couple of weeks from international equities. With that international equities asset class cash percent rank dropping precipitously over the past few weeks, moving down from the mid zone, which we were at a couple of weeks ago, the average yellow average reading with the indicator above 33%, dropping back down beneath the 33% line to give us that green strong reading for international equities against cash, and then dropping even further there on Friday down to 13 for the 13th percentile, which is actually the lowest reading we've had for the international equities asset class since mid-2018. So definitely an interesting point to note, and will be an interesting point to keep an eye out for to see if that cash percentile rank continues to drop for the international equity space. So definitely no shortage of things to follow here on the DALI page. And we've seen some of these recent movements as further improvement from many of these risk-on areas, also reflected on some other relative comparisons we have on the platform, such as the asset class group scores page. This page is going to be a little bit different kind of comparison, looking not strictly just at relative strength, but also incorporating the normal trend analysis factor that goes into fund scores to give us more kind of multi-pronged approach that we're looking at from an average fund score perspective of each of the representatives that are going to be included in each of these groups. Again, this asset class group scores ranking has many different views that we can look at. There's 135 groups in total. And here we're just looking at the macro view filter. So those bigger picture, more broader representative areas of the investable market from around the world. And in looking at that, we see a similar mindset display that we see those more risk-on areas have shown kind of consistent strength from these rankings. With the S&P 500 index funds group, our U.S. core equity representative, still sitting in the top spot out of the macro view representatives, and sitting pretty high from a broad standpoint as well across all 135 areas, with it up at moving the U.S. equity core percent rank at 92%. So very elevated territory there for the core domestic equity market space. And we continue to see very low field position from our cash representative, the U.S. money market group, sitting down at a low field position there relative to the rest of the groups, and putting it at the money market percent rank at just 2%, where it's remained beneath that 5% level for several weeks at this point. Other areas that are showing some improvement more recently, such as your emerging market space with international equities, showing significant improvement there from a directional standpoint, at the highest directional reading from any of these groups that we see displayed in front of us, at an average forward direction of 2.46. So that's significant improvement from the flow over the past 6 months. And also seeing the small cap space as well. We've seen the small cap area really pick up the pace over the past few weeks, has been touched out throughout the research and in these media content videos, but has moved it to a higher score position as well. But we also note that those two areas specifically that have shown that consistent strength, that more rapid rise recently, are moving into more overbought territory. So we've touched on this a bit over the course of the past few weeks, but it's definitely interesting to note that the core market in and of itself is certainly at higher overbought levels than we've seen over the past few weeks. But it's really those areas, those laggard areas, have shown that significant strength over the past several weeks that have moved into what we would consider to be more elevated, more higher, more overbought territory currently. So definitely will be an interesting point to keep an eye out there, Will, to see if that improvement leads to some normalization from some of those more overbought areas, while we see that kind of consistent growth sustained from the broader core domestic space.
Yeah, Ian, absolutely. I think those are great points, and excellent distinction that you made between that core equity market representative being that S&P 500 group, and then some of those previous laggards or smaller size and style groups that have participated so much lately that they are now in a bit more of a frothy market environment or frothy territory. So I think that is important to note. And like always, it's important to know what you own on an individual position management basis, looking at weight of the evidence for security or weight of the evidence for an asset class, as we've tried to convey here. And in aggregate, though, Ian, just to sum up a few things before we part ways today, by and large, we're seeing a demand, whether it be through DALI, asset class group scores, broad market indexes. There's a demand for risk on assets. There is increased participation in the domestic front, beginning with from various sectors. Those lagging sectors, as we've talked about, have become a bit more frothy, but by and large, positive movements. Lots of stocks are trading on buy signals, again, furthering that participation and broad movement higher. Internationally, we're also seeing that demand for risk on. You have your emerging markets groups doing well, along with various other countries from a shorter term and a longer term perspective. Just keep in mind that potential for overextension there as well. But by and large, positive movements, positive things we're seeing. And Ian, I believe that will do it for us today. So if you're listening to this, we thank you for your time. And if you'd ever like to reach out individually, we're happy to communicate via phone or email listed at the bottom of the screen here. And with that, we will thank you one more time, and we will hope